Let's take a look at this week's webinar calendar. If you're a fixed income investor or you've been thinking about how maybe a safer investment could actually be a better idea, then join us on this premiere where we're going to talk about why fixed income investing is timeless. The premiere happens at 10 a.m. on Saturday and it's something new that we're trying. If you've been staying up at night because of market volatility or checking your portfolio multiple times a day and are on edge, then we've got the perfect webinar for you with Yuvraj talking about how you can take advantage of market volatility and what you should be expecting out of your advisor in a year like 2025. If you're a global Indian and are looking at investment opportunities across the world, then definitely China has been on your radar. And if you want to know what the real investment opportunity is in China, then join Harshal on Sunday at 10 a.m. IST where he's going to be talking about the China opportunity. So these are the webinars that we have in store for you. There's definitely something that you could learn about financial markets this weekend. Which webinar are you going to join? Click on the link in the description below to register yourself.
In this episode of Talking Straight, we are going to continue to discuss on investing in mutual funds and similar products with Subramanyam. I'm going to start with a subject which I have been closely influenced by more in the later years of my investment career. I've been an investor for 36 years. For 20 years, I never had to bother about one thing. In fact, many days I would not know where that thing was. Was it up? How much was it? What was the number it was trading at? What was its performance over 1 month, 3 months, 6 months, 1 year, 3 year, 5 year? I never had to bother about it. And yet, in what I did, I could manage to leave it far behind. I am going to talk about the benchmark first, because as an investor, I believe that what matters to me is my return expectation, the kind of risks I take to fulfill my return expectation, and whether I beat my return expectation. And in those 2 decades which I spent as an investor, I did not set low return expectations. My return expectations were definitely on the higher side. And yet, I focused on how I need to fulfill my return expectations rather than how I needed to be better than a benchmark. But in professional investing, everything is centered around a benchmark. It's like you go home from school with your report card. Your parent takes the report card and looks at all your marks. And the first question they ask you is, how much did Ram get? How much did Sushil get? How much did Kumar get? How much did Vinod get? So, the natural tendency is to compare with how others did. It's not so much how you did, what were your circumstances, how did you prepare, what expectation did you prepare with for the exam and how did you perform. So, this is a very, very Indian thing and it's got to extremes these days. To such an extreme that people compare daily, weekly, fortnightly, monthly, quarterly, 6 month and annual outperformance versus benchmark. Does this comparison make the person who is managing the money a better manager? In my assessment, big scorers don't achieve their big scores by looking most of the time at the scorecard. Most of the time is spent surveying the field, studying the bowler, studying the conditions and studying the gaps. Like in cricket, so in investing. I'm going to ask Subra what is his view of the benchmark. How he has seen the benchmark in his experience as an investor and as an advisor. What do you think, Subra?
I have 3 roles. First as an investor, and then as a broker. I was a member at National Stock Exchange and then as a mutual fund investor. And till I came to mutual funds, I didn't know there was something called a benchmark with which you should be compared. Because my client in broking, and that time I was a portfolio manager come broker, because you said what to buy and what to keep and all that. He never bothered about what others got. I couldn't tell him, I know you underperformed, but your neighbor performed well, or something like that. To him, it didn't matter. He was an absolute return seeker, and you'll have a good year or a bad year. I mean, or you'll have good shares or bad shares. Sometimes you'd make money, sometimes you wouldn't make money. But telling him the market fell 2% and your portfolio fell only 1%, I've done a great job, was not going to impress him. So to him, index didn't matter. And till date, I don't know of any investor for whom index matters, because he doesn't anyway invest in the index. He buys something in small cap, mid cap and all that. He has an assortment. He calls it a portfolio, which may or may not be a portfolio, and has nothing to do with the index. Right? So there are people who say, oh, index, I don't know what is happening with the index, but my shares have done well. And somebody would say, oh, index has fallen. But I have never had anybody, even as in mutual fund training, etc., ever say my portfolio compared to the index has done well. They don't look at it that way. They see how much has my fund done. That's it. To them the benchmark doesn't matter. For them, okay, I've invested in small cap has done well. He doesn't care whether it did well compared to the benchmark. For example, I remember one of the years, the benchmark was 59%. I think small cap gave some 59%. Which means I had to go and tell a client who has got 55% saying, sorry, but I've underperformed the benchmark. Honestly, he couldn't care.
No, but there's so many articles.
Yeah. Yeah, I mean, articles on fund managers say that 3 years he has underperformed the benchmark.
In this year when this happened, the guy who took lower risk, kept the portfolio safe, let's say made 45. So the guy who kept the portfolio safe took lower risks and ensured that the returns were reasonable. And the risks were also under check. Was seen as a loser.
Correct.
And the guy who did crazy things,
correct,
which he ought not to have done,
yeah,
he might have even invested in operated stocks. And that's sitting there as performance.
Yeah.
He might have induced momentum in those stocks.
Yeah. So,
he was king. Yeah. And the articles, such glowing articles by our financial and fund analysts, like I was reading them and I was like wondering whether they know what they're talking about.
But which investor in his senses is going to entertain you saying, sorry, but this fund has underperformed, it has got only 55% and not 59. Your client is going to say, you said 12, you've given me 55, why are you apologizing?
So there is another aspect to this, another dimension to this, which I found very interesting. So when I came into mutual funds, I told my guys, don't engage in individual product level performance evaluation. Don't do that. You always give a client a portfolio level evaluation. If the client wants to benchmark Nifty, because he is paying you money, you are receiving money, you have to be accountable to the money, not at the product level, but at the portfolio level. So you compute what is the portfolio return and what Nifty has done. If he wants a review of performance, give this. So they would prepare in Excel elaborately for each client, go and say to the client, show him the statement. In some cases, not all, but exceptions, they would come back and tell me, sir, I did what you did, but the client is talking about this PSU fund which we are owning, which is not beating Nifty. And they would go again and again and again with the same conversation for 1 year, 2 years, 3 years. Then what the client was trying to do is sell this and buy something else. That was what he was trying. He wants to only have funds which always beat the benchmark. So if you do that, you will never be a contrary investor. You will never catch that multi-bagger swing in the PSU where you could have well doubled or tripled your money.
True.
And you will never buy what is very favorable in value but out of favor with the market.
Correct.
But that obsession to look at the product level or stock level. If it's a PMS, why is this stock underperforming? That obsession is not there when it comes to portfolio level. But that conversation done at the individual product level is meaningless, because in any portfolio of stock or fund, there will be a few things which always underperform in the near term, market perform in the medium term, and outperform in the long term. If you are not able to handle the near term and the medium term, you are not going to get the fruits of the long term outperformance.
True.
So benchmarking, when you do it in a very microscopic sense, actually can come to hurt. I have seen a client who made it very personal about owning a PSU fund, which was 7-8% of his portfolio, half funds. He had other funds which are doing very well. He was above the benchmark at portfolio level by 200-300 points, even in the bear market. And friends like him in the bull market went 400-500 points at portfolio level above the benchmark. But in the bear market, he became so flustered and very disturbed that because of this investment which was disturbing him, which is a PSU fund at the market bottom, he sold his entire portfolio, Subra. He redeemed everything, sold everything and went, I don't know what he did. But the point is, there are investors like this who obsess about every investment beating benchmark all the time. Whereas I have seen the companies which gave me maximum returns as an investor went away in the other direction, negative for 3-4 years. And because they became negative 3-4 years, at the end of the 3-4 years, I go and make a small incremental position in them. Suppose I am holding 2% of the portfolio, I make it 4. And from there it
Flies.
flies.
Yeah, absolutely.
And the extra 2% makes, at the portfolio level, it triples. So portfolio level it makes 4%, please understand. I got my entire portfolio outperformance from a 2% investment decision which is incremental, right? And these guys, in the name of review, in the name of actually keeping the advisor in check, don't even give themselves the chance to get this low incremental risk, high incremental reward growing in their portfolio.
There are times when it's very important to make sure that the end client does not get carried away by what he hears. Because what happens is, you say these 2-3 fund managers are very good, and they watch them on television, and that person says, oh, now is the time to do some fund which is a debt or something like that, and they come back and say we need to do that. So that is one thing which is noise. Benchmarking is another noise. You cannot help it. But then I turn and say, aren't you the guy who sold your HDFC ESOP and Axis Bank ESOP at bad prices? So you shouldn't be talking about fund management. Then he shuts up. But this can happen only when the relationship is very good. And
Where you can speak truth to power.
Where you can
Customer is
speak like
powerful.
that is because otherwise the customer will say, whom are you to talk to me like this? And it also, I think, comes with age. You can't expect a 24-year-old customer to talk like that to the end customer. So these are two things which vary about benchmark. But there are many fund managers who don't like the benchmark, and comparing the benchmark on, like you said, on a weekly, monthly, hourly, quarterly basis makes no sense. It increases stress for the fund
Investor
manager,
first.
for the investor and for the fund manager also. Because I have seen a fund which was performing reasonably okay, not too good, where it had a stake in Vodafone, and at a time when Bharti was not performing well, and Tata Motor DVR, all three were not performing well. But all three put together was less than 5% of the portfolio, and the 30 minutes which she had for doing the review, 25 minutes was taken away by this. So I was old enough to get up and say, guys, 5% of the portfolio, you've spent 25% of the time. Let us talk about those things which have done well. This is so stupid to be talking about
I think
this.
that when you have a discussion on performance or review, getting into individual investments and spending so much time with your advisor on those investments,
Or even with the fund manager.
and even with
those
in my
investments.
opinion, is an unproductive exercise. That means you don't have trust and faith in the wisdom of that manager.
Then get out of that manager.
Yeah, correct. Actually, don't be.
Don't be there in the last 5%
Yeah,
the
indeed.
tail of the portfolio. You spend half an hour of her time or his time. Just not done.
Your time.
All
So anybody who
all
argues like this,
yeah.
typically a person who argues like this is at least a 5 lakh per month salary person,
Correct.
right?
Correct.
5 lakhs per month. So 20 working days.
Correct.
What is this
Yeah.
daily?
Yeah.
25k. 8 hours.
And he may be.
He argues for 1 hour. 3k he puts on the table.
Correct.
His time.
Yeah.
It's meaningless actually.
Yeah, and
It's absolutely meaningless, and he becomes more anxious, takes a stance, then tries to defend that stance. Then it's him versus the other side, who is right. Then it becomes egoistic and completely unproductive, totally unproductive discussion.
correct.
I've seen many of these things. That is what made me actually keep a lot of people away from things which they cannot handle. For example, I can write a portfolio of the best thematic funds. I can write at any point in time. And I can make it better and better when other funds come into favor. And that portfolio of thematic funds may give him, let's say, 500 basis points over benchmark. Portfolio will give, the way we manage. Because teams have a higher beta, right? So, but what I realized is, if I don't do that and I buy simpler products, I would make maybe 400 or 350. 400 over the benchmark you can make in the long run. For that 1%, the amount of time we would spend convincing the investor on the merits of the themes makes it completely worthless. In fact, this is why I stopped doing RIA. Because we are doing it through thematics, we are constructing a risk approach which is so nuanced. And the investor is not getting the nuance at all, Subra.
Correct.
Okay. The benchmark difference I found is only 1%. I'd rather keep him calm.
Correct.
Than, do all these things. This is my expertise. Okay. When I do it this way, I get a kick. My ego will be happy that I did this like nobody else and all that. But it's not good for him. Even in benchmarking, there are certain consequences which you need to avoid. I'm just giving you an example. For 1%, don't take the investor through this. He deserves better.
Correct.
So, whatever knowledge you have, you put it to sleep. Use it rarely. For example, when you market extreme, you can buy a theme to the extent of 3-4% or 5% of the portfolio.
Correct.
If you are right, it will go to 10%.
Correct.
But it will double. And the extra 5% will be your benchmark outperformance. Even if the rest of the portfolio is as good as the benchmark, one investment is enough to beat the benchmark.
Correct.
Just one investment.
Correct.
And chances are, if you are having a complete buy-in of investor, you can do better. You can buy more than one. So, I find this benchmark beating to be very, very unproductive because it is done at the wrong time. And when it is a time to actually take decisions which will beat the benchmark, people are doing reviews of the benchmark performance.
Correct.
So, while I am not averse to people doing their own measurement, the inference doesn't come out the way it should come out. If the inference is correct, I am okay. Okay, now we are not performed. Is there something which we can do today? 5% of the portfolio. I am not talking about 100%. 5% of the portfolio. Can I take a decision which will, give me portfolio level? Many people never understood. If I am buying PSU to the extent of 5%, my logic is it will double and give you 5% portfolio level outperformance.
I mean, I use benchmark, like you said, only at the extremes to see if there's a significant drop. Then you say, compared to the benchmark, what has the fund manager done? And if I'm happy with what the fund manager has done, I don't bother.
There's one more thing that comes into all this. See, to beat the benchmark significantly at the portfolio level, I told you that thematics help. But Subra, the TER of thematics will always be high. It will not be low. It's a smaller fund, right? It has costs. So the TER will always be high. People keep on questioning, why are you buying this fund? It has got high TER. Their obsession with TER. So they'll compare with some other fund which is a very large 30,000-40,000 crore fund. This is a 1,000 crore fund. At 1,000 crore, he doesn't make so much money.
Correct.
Even at a high TER. So the whole question of the fund choice, instead of being on the investment merit, shifts to the cost.
And to the benchmark related performance on a short-term basis.
Short-term basis. So that
both of that hurt the investor. It does not matter to the fund manager.
But understand one thing. When advised, all these questions come. People ask all these questions when they are advised. Same people last year went on their own and bought defense. Went on their own and bought capital market index. All index. Okay. Maybe the TER was acceptable to them. But the valuation was crazy.
Correct.
They completely missed the woods for the trees.
Yeah, but there is this theory that you keep buying the index for the rest of your life and you can't go wrong. But
You can't buy defense index all your life and go right. And you can't buy.
There are too many indices now. If there is only one index called the Sensex or Nifty, you may be right in the long run. But there is a defense index, there is a pharma index, there is IT index. Which index, right? So I keep asking, what index are you talking about when your portfolio has nothing to do with the index? So you don't need to look at, for most people, they need to look at index. Only the fund manager needs to look at the index and say, why is he so far away from it? For the real investor, as long as he is convinced that the fund manager is not doing a bad job, I think indexing is just noise. I wouldn't go and tell the fund manager you are underperforming the index. I may say you are underperforming peer group, you are underperforming something else, but to me, him underperforming the index doesn't bother me.
So, Subra, some styles will underperform. Na? Somebody has got a certain style which will underperform. I'm going to give you an example. There was this brilliant fund manager who was running a value fund. He had overloaded. Sun Pharma had those issues, you remember, corporate governance and all those things for a brief period, and they recovered. They committed to cleaning up, and everything was done in a way in which you could see that they are doing the right things.
Correct.
Stock price fell from some
1400, 200 to
500.
Yeah.
At 500, everything was factored in, all the negatives factored.
Correct.
This guy was hounded by, and he had 2-3 other stocks like this. Not with the corporate governance, some other factors which are temporary,
higher risk,
and not going in favor of the company, going against the company. Seeing the portfolio, I felt that this guy's current portfolio was rocking. And I was telling his sales colleagues that, look at this guy, he's got a super portfolio. In your company, this is the best portfolio, I am telling. Right up to the CEO. Nobody is listening. Everyone is telling me, giving me reverse gyan that, kya yaar, performance nahi hai. Their own insiders.
True.
I said this portfolio is your company's rock star today. Right? But wherever they went, their sales guys, all these guys, client facing guys, hounded this guy saying performance nahi hai, performance nahi hai, performance nahi hai. And then that portfolio just took off, Subra. It just took off. All the stocks fired. Right? Today that portfolio is being seen as, oh, it's got more than 2 decades performance. Right? But the manager is not there. He's moved on. Right? You had a highly competent guy who is doing all the right things. Circumstances didn't favor him for, let's say, 12 months or 24 months.
Correct.
Max.
Correct.
So that we have lived as investors where circumstances didn't favor for 4 years, and the 5th, 6th and 7th year,
Correct.
we made 8x.
Correct.
These, I don't want to use Gali now, these characters are so immature that they are not able to judge the portfolio. Can only look at benchmarking.
Correct.
It's bright and sunny, and the conversation is also hotting up. We had a very warm conversation on benchmarks. I'm not sure how many people are going to like what I said, but Subra was very sober. And we are going to continue this conversation on mutual funds into something even more interesting. So stay tuned. We are continuing talking straight with Subramanyam.